Hello and welcome to Calmvestor podcast. I am Ethan. Join me on this journey to build solid financial thinking and take control of your financial future. Today, I want to share a startling truth. Did you know that tiny, almost invisible fees could be making a significant portion of your investment profits vanish over time without you even noticing? Imagine two investors, let's call them Alex and Ben. Both start with $10,000 and earn a gross return of 9% per year. Alex's fund has a management fee of 0.5%, while Ben's fund charges 2%. After 25 years, the difference is staggering. Alex could have around $70,000. Ben, on the other hand, might only have about $50,000. That is a $20,000 difference, almost double their initial capital, lost to higher fees. So let me ask you directly, are you unintentionally paying too much to the people managing your money? Is that fee genuinely worth the performance they deliver? The silent enemy we are talking about today is fund management fees, especially those from high-cost funds that do not deliver superior performance. As Benjamin Franklin wisely said, beware of little expenses. A small leak can sink a great ship. Consider this. If you invest $5,000 in a fund with a hypothetical return of 8% per year, with a 2% management fee, your net return is 6%. After 30 years, you would have about $28,700. Now, if that fee was only 0.5%, your net return becomes 7.5%. After 30 years, you could have around $43,700. That is a difference of $15,000, just from a 1.5% fee each year. So, what exactly are these fund management fees? The most common one is the management fee or expense ratio, often abbreviated as TER, for total expense ratio. This is an annual fee you pay to the fund management company. This fee covers their operational costs, research, expert salaries, marketing, and more. It is calculated as a percentage of your total invested assets. But this is not the only fee you might encounter. There can be other charges too. A front-end load is a fee paid when you buy into the fund. A back-end load, or deferred sales charge, is paid when you sell, often decreasing the longer you hold the investment. You might also see fund conversion fees if you switch between funds within the same company, or even performance fees, which are an additional reward if the fund outperforms a specific benchmark. Now, fund management companies do provide a service and expertise, so charging a fee is reasonable. The real issue lies in the level of these fees and the actual value you receive in return. It is important to distinguish between actively managed funds and passively managed funds. Active funds, where managers try to pick winning investments, generally have higher fees than passive funds like index funds or ETFs, which simply aim to track a market index. John C. Bogle, the founder of Vanguard, famously said, "In investing, you get what you do not pay for. Costs really matter." This is a powerful reminder to focus on what you keep. If you look at a fund fact sheet, you will find the total expense ratio, or TER. These fees are typically deducted from the fund's net asset value, or NAV, often without you seeing a direct debit. Why are these fees such a silent enemy? Because they work like reverse compound interest. Just as compound interest helps your money grow exponentially, it also causes small fees to accumulate into substantial amounts over decades. A fee of 1 or 2% might seem insignificant annually, but over 20 or 30 years, it can consume a third or even more of your potential profits. That is a huge chunk of your financial future. Information about fees is often buried in long, complex documents, making it difficult for investors to find or understand. It is easy to overlook what you do not easily see. Then there are psychological biases. Some think, oh, it is just a small fee, it will not matter much. Others assume you get what you pay for, believing high-fee funds must be better or managed by superior experts. Many investors are also swayed by advertisements boasting impressive past returns, forgetting to scrutinize the associated costs. Past performance, as they say, is no guarantee of future results, especially after high fees. The reality is that many actively managed funds with high fees fail to consistently outperform the market, represented by benchmarks like the S&P 500 after their costs are deducted. Warren Buffett once said, "Price is what you pay, value is what you get." This perfectly applies here. Are the fees you are paying justified by the value and performance the fund delivers? Imagine Fund A reports a 15% return for the year, but has a 3% management fee. Fund B, perhaps an index fund, returns 13% with a 0.5% fee. Which is better? Fund A's net return is 12%. Fund B's net return is 12.5%. Fund B is actually the better performer for your pocket, despite its lower gross return. This is the power of lower fees. What are the root causes for investors overlooking these crucial fees? A primary reason is a lack of financial education and awareness about the long-term impact of costs. The sheer variety and complexity of fund products, each with its own fee structure, also makes comparison challenging for the average investor. It is like navigating a maze. Behavioral biases also play a role. Confirmation bias might lead you to seek information that confirms your chosen fund is good, while ignoring warning signs about high fees. FOMO, or fear of missing out, can push you into hot funds without proper due diligence on costs. The fund industry's marketing often emphasizes past performance or star fund managers with less focus on fees. Additionally, financial advisors might be incentivized to recommend funds with higher fees because they earn higher commissions. Finally, some investor passivity contributes to the problem. Many people entrust their money entirely to experts without proactively researching or evaluating the costs involved. As Warren Buffett also noted, risk comes from not knowing what you are doing. So how can you combat this silent enemy? The good news is, you have more control than you think. Let's explore some actionable solutions. First, become a fee detective. This means reading and understanding the fund's documents. Look for the prospectus and the fund fact sheet on the fund company's website. The key number you are searching for is the TER, or total expense ratio. Always compare the TER of funds within the same category. For instance, compare equity funds with other equity funds. And do not hesitate to ask your financial advisor to clarify all the fees you will be paying. What are they really charging you for? Second, consider making friends with low-cost index funds and ETFs. Why are their costs low? Because they passively track a market index, like the S&P 500 or your local market index. They do not need a large team of analysts to pick stocks. Numerous studies, such as the SPIVA reports, show that over the long term, a majority of actively managed funds with higher fees fail to beat their benchmark index after accounting for those fees. Even Warren Buffett has repeatedly advised individual investors to opt for low-cost S&P 500 index funds. Third, evaluate the real value. Always focus on net returns, which is your return after all fees have been deducted. Do not be dazzled by gross returns alone. Look at a fund's performance over the long haul, 3, 5, or even 10 years if available, not just the latest year. A fund might get lucky one year, but high fees make it harder to consistently deliver superior results. If a fund has very high fees, its performance must be exceptionally and consistently outstanding to justify those costs. Otherwise, you are essentially paying more for underperformance. Is that a deal you want to make? As Burton Malkiel, author of A Random Walk Down Wall Street, stated, the lower the fee an investment fund charges, the higher your share of the return. And John Bogle reinforced this. Successful investing in funds is not about picking winners, but about avoiding losers and minimizing costs. To illustrate, you can usually find the TER on a fund company's website under Fund Documents. An ETF tracking a major index might have a TER of, say, 0.1% to 0.8%, while an active equity fund could charge 1.5 to 2.5% or even more. Imagine investing $50,000. A 1.5% difference in fees annually means $750 more in your pocket or compounded for your future each year. Over 10 or 20 years, this really adds up. So, to wrap up, management fees are no longer a silent enemy. If you actively identify and manage them, you have the power to make informed choices. Every fraction of a percent in fees that you save today will compound into a significant sum in your future, thanks to the magic of compound interest working in your favor, not against you. Intelligent investing is not always about finding complex strategies. It is often about mastering fundamental principles, and optimizing costs is a critical one. Remember investor Alex from our earlier story? By choosing a lower fee fund, Alex built a much more secure financial future. Feel confident to ask questions, compare your options, and make wise decisions. Your financial destiny is in your hands. As Jim Rohn said, discipline is the bridge between goals and accomplishment. Being disciplined about costs will help you reach your financial goals. A small action today, like reviewing your current investment fees or researching a low-cost index fund, can create a massive positive difference for your tomorrow. So what is your first step going to be? Here are a few simple actions you can take. Right after this podcast, open your investment account statements. Check how much you are currently paying in fees for the funds you hold. Then, sometime this week, dedicate just 30 minutes to research at least one low-cost index fund or ETF available in your market. Knowledge is power. And finally, if you found this useful, share this podcast with at least one friend or family member who you think could benefit from this information. Let us all become savvier investors together. Thanks for listening. If you found this content valuable, do not forget to hit like and subscribe to the channel. See you in the next episode. Have an amazing day filled with positive energy.